Have you ever felt like the market is speaking a language you only partially understand? Numbers dance across the screen, charts rise and fall, but something vital remains unspoken. That unspoken element, that intuitive grasp of a company's true character, that's where qualitative analysis steps in. It's the art of seeing beyond the spreadsheets, of understanding the human story behind the financial statements. Why is this so critical? Because numbers alone can be deceptive. They can tell you what asterisk has asterisk happened, but they can't reliably predict what asterisk will asterisk happen. A purely quantitative approach is like navigating a ship with only a speedometer, knowing your current speed but blind to the iceberg ahead. Qualitative analysis is your radar, your intuition, your ability to sense the unseen currents that shape a company's destiny. Think of it like this. Benjamin Graham, the father of value investing, always emphasized the importance of a margin of safety. He sought companies so fundamentally strong that they could withstand unforeseen challenges. But how do you measure that strength? How do you quantify resilience, adaptability, or the quality of management? The answer lies in qualitative analysis, in understanding the economic moat that protects a company from its competitors. An economic moat is a sustainable competitive advantage, something that allows a company to consistently outperform its rivals. It could be a powerful brand, a patented technology, a unique distribution network, or even a deeply ingrained culture of innovation. Identifying these moats is the key to finding truly enduring investments, the companies that will not only survive but thrive in the long run. In this video, we are uncovering the hidden truths behind wealth accumulation. We will be diving into data-driven strategies for qualitative analysis, techniques that will empower you to see beyond the headlines and understand the why behind every investment decision. These aren't just abstract concepts, they're practical tools that you can use to assess management quality, brand reputation, competitive landscape, and a company's ability to adapt to change. Challenge the consensus. Find your edge. Are you ready to sharpen your investment radar? The first strategy in our qualitative arsenal is what I call the management DNA test. We're not just looking at resumes or press releases. We're diving deep into the core values, the decision-making processes, and the long-term vision of the leadership team. After all, a company is often a reflection of its leaders. How do we do this? Start by scrutinizing their capital allocation decisions. Are they empire builders, recklessly acquiring companies at inflated prices? Or are they disciplined investors, carefully deploying capital to generate long-term shareholder value? Look for a history of smart, strategic investments, not just chasing the latest trends. Don't just invest, understand the why behind every decision. It's easy to be seduced by charismatic leaders, the ones who can captivate an audience with their vision. But remember, substance trumps style. A leader with integrity, competence, and a clear strategic vision will always outperform a charismatic but ultimately ineffective one. Think of Warren Buffett's quiet, steady leadership versus the flash-in-the-pan CEOs who promise the moon but deliver only dust. And perhaps most importantly, how has management navigated past crises? A truly great leadership team doesn't just thrive in good times, they excel in bad times. They adapt, they innovate, and they emerge stronger than before. Look for examples of resilience, of tough decisions made with long-term shareholder value in mind. Finally, be aware of the red flags. Excessive executive compensation, a history of questionable accounting practices, a lack of transparency. These are all warning signs that should prompt you to dig deeper. Remember, independent research and critical thinking are your best defenses against a management team that puts its own interests ahead of yours. Is your diversified portfolio truly diversified? Our second strategy brings us to the competitive landscape, using Porter's 5 forces as our guide, but with a data-driven twist. Michael Porter's framework helps us understand the forces at play in any industry. The bargaining power of suppliers, the bargaining power of buyers, the threat of new entrants, the threat of substitute products, and the intensity of competitive rivalry. But instead of just relying on intuition or anecdotal evidence, we want to quantify these forces whenever possible. For example, to assess the bargaining power of suppliers, we can look at concentration ratios. How many suppliers control a significant portion of the market? If there are only a few dominant players, they have more leverage to raise prices. Similarly, to gauge the bargaining power of buyers, we can analyze switching costs. How easy is it for customers to switch to a competitor's product or service? If switching costs are low, buyers have more power to demand lower prices. Beyond the headlines, what's really driving the market? Now, a word of caution. Don't assume that high barriers to entry always guarantee profitability. Just because it's difficult for new competitors to enter an industry doesn't mean that existing players are immune to disruption. Think of the taxi industry before Uber, or the camera industry before digital photography. Disruptive innovation can completely upend an industry, no matter how high the barriers to entry may seem. Consider the music industry, transformed by digital downloads and streaming marketing services. Applying Porter's 5 forces, we can see how the bargaining power shifted from record labels to consumers, and how the threat of new entrants like Spotify and Apple Music reshaped the competitive landscape. So, how do you apply this in practice? Pick an industry you're interested in and map out the competitive landscape using Porter's 5 forces. Gather data on supplier concentration, beer switching costs, and the potential for disruptive innovation. This data-driven approach will give you a much clearer picture of the industry's attractiveness and the potential for long-term profitability. We are uncovering the hidden truths behind wealth accumulation. Strategy number 3, the brand equity audit. We often hear about the power of brands, but how do we measure something so seemingly intangible? Brand equity, the value associated with a brand, is a powerful driver of customer loyalty and pricing power. A strong brand allows a company to charge a premium for its products or services and retain customers even in the face of competition. But brand equity isn't just about logos and slogans. It's about customer perceptions, experiences, and the overall reputation of the company. Fortunately, we can use data to measure these things in a tangible way. Consider the Net Promoter Score, or NPS. This metric measures customer loyalty by asking customers how likely they are to recommend a company to a friend or colleague. A high NPS score indicates strong brand advocacy and customer satisfaction. Social media engagement, website traffic, and customer reviews are other valuable sources of data that can help us gauge brand awareness and sentiment. Now, some might argue that brand equity is purely subjective and unquantifiable, but the data tells a different story. Numerous studies have shown a strong correlation between strong brands and superior financial performance. Companies with high brand equity tend to have higher revenue growth, higher profit margins, and stronger stock performance. Don't just invest, understand the why behind every decision. However, brand equity is not static. It needs to be nurtured and maintained over time. Factors such as brand authenticity, consistency, and relevance are crucial for sustaining brand equity in the long run. A brand that is perceived as disingenuous or out of touch will quickly lose its appeal. So, how do we value a company's brand equity? One approach is to estimate the premium that customers are willing to pay for the brand's products or services compared to generic alternatives. Another approach is to analyze the brand's contribution to overall revenue and profitability. Remember, a strong brand is a valuable asset that can generate long-term returns for investors. Challenge the consensus. Find your edge. Our 4th strategy takes us beneath the surface into the corporate culture deep dive. Corporate culture, often unseen, is a potent force driving employee engagement, innovation, and ultimately performance. A thriving culture attracts and retains top talent, fosters creativity, and promotes a shared sense of purpose. But how do we assess something as seemingly amorphous as corporate culture? Fortunately, there's a wealth of data available to us. Employee review sites like Glassdoor provide valuable insights into employee sentiment, work-life balance, and management effectiveness. Look for patterns and trends in these reviews, paying attention to both positive and negative feedback. It's easy to assume that corporate culture is solely the responsibility of HR. However, a truly strong culture requires buy-in from leadership at all levels. Employees need to feel empowered, valued, and supported in their roles. A top-down, authoritarian approach is unlikely to foster a culture of innovation and collaboration. Is your diversified portfolio truly diversified? Consider a company like Google, often cited for its innovative and employee-centric culture. Google provides its employees with a wide range of benefits, opportunities for growth, and a sense of purpose. This, in turn, has fueled Google's innovation and financial success. However, be aware of the red flags. A lack of transparency, a high rate of employee turnover, and a culture of fear are all warning signs that should prompt you to dig deeper. Remember, a toxic corporate culture can erode a company's value over time, no matter how strong its financial statements may appear. So, before you invest in a company, take the time to understand its corporate culture. Read employee reviews, talk to current or former employees if possible, and look for evidence of a healthy and thriving work environment. This due diligence can help you avoid investing in companies with hidden cultural risks. We are uncovering the hidden truths behind wealth accumulation. Our final strategy brings us to the ESG factor, integrating environmental, social, and governance considerations into our qualitative analysis. ESG investing is no longer a niche trend. It's rapidly becoming a mainstream approach, reflecting a growing awareness of the interconnectedness between business, society, and the environment. ESG data allows us to assess a company's environmental impact, its social responsibility, and its corporate governance practices. Are they minimizing their carbon footprint? Are they treating their employees fairly? Are they governed by a strong and independent board of directors? These are all questions that ESG data can help us answer. It's a myth that ESG investing is purely altruistic and detrimental to financial returns. In fact, fact, a growing body of evidence suggests that companies with strong ESG performance tend to outperform their peers in the long run. This is because ESG factors can be powerful indicators of a company's long-term sustainability and resilience. Beyond the headlines, what's really driving the market? Integrating ESG considerations into your qualitative analysis requires a focus on materiality. Which ESG factors are most relevant to a particular company or industry? For example, a company in the energy sector will face different ESG challenges than a company in the technology sector. So, how do you assess the ESG risks and opportunities of a specific company? Start by gathering data from reputable ESG rating agencies. Then, dig deeper to understand how the company is managing its ESG risks and capitalizing on its ESG opportunities. Remember, ESG is not just about doing good. It's about building a more sustainable and profitable business for the long term. Don't just invest, understand the why behind every decision. So, we've journeyed through 8 hidden strategies for qualitative analysis, each designed to sharpen your investment radar and help you see beyond the surface. We explored the management DNA test, decoding the competitive landscape with Porter's 5 forces, auditing brand equity, diving deep into corporate culture, and integrating the ESG factor. These aren't just abstract concepts. They're practical tools that you can use to make more informed and profitable investment decisions. Remember, the key is to combine these qualitative insights with your quantitative analysis. Don't just rely on numbers. Understand the story behind the numbers. Dig deep, ask questions, and challenge the conventional wisdom. A truly holistic investment approach considers both the tangible and the intangible, the measurable and the immeasurable. Warren Buffett, a disciple of Benjamin Graham, has always emphasized the importance of intrinsic value. He seeks to understand a company's true worth, not just its current market price. And qualitative analysis is essential for assessing that intrinsic value, for understanding a company's competitive advantages, its management quality, and its long-term prospects. Now, it's your turn. Take these strategies and apply them to your own investment decisions. Do your own research, think critically, and don't be afraid to challenge the consensus. The market rewards independent thinkers, those who are willing to do the work to understand a company's true potential. The path to sustainable investment success is not paved with quick fixes or easy answers. It requires discipline, patience, and a commitment to continuous learning. But by mastering qualitative analysis and integrating it with your quantitative skills, you'll be well on your way to unlocking long-term wealth creation. Challenge the consensus. Find your edge as you reflect on these strategies. Consider this: what hidden strengths or overlooked risks might be lurking beneath the surface of your current investments?